Creative financing for real estate is where you buy real estate using more of your creativity than your cash. But you can sell real estate with creative financing too. And a lot of people are talking about it right now being the ultimate cash flow exit strategy. Because when you're in a seller's market, like the one we're in right now, you can really maximize profits and create no stress cash flow. I'll show you how to do it and how to get a good result, or you could get a great result. By the time we're done, you'll know how to do both. And before we begin, click the subscribe button and ring the notification bell because I post important stuff like this each and every week and you don't want to miss it. Let's go. Hi, I'm Matt Theriault, CEO of Epic Real Estate, where we show busy professionals how to shift from W-2 paychecks to real estate profits by deploying more of their mind than their money, using creative financing strategies, all in the interest of retiring early. If you don't know how to creatively finance your real estate, there'll be a ton of opportunity and money that slips through your fingers just like them grains of sand at the beach. But if you get this right, you'll do more deals, spend less on marketing, and escape the daily grind far faster than you could without it. And that's because you can bring home more monthly money by doing less when selling your properties with creative financing. Instead of being a landlord owning the property, you would be the bank lending to the owner of the property. I'll compare the two side by side so you can choose which exit strategy is better for you. But if you'd like to learn more on how to buy property using creative financing, I put together a series on just that, Creative Real Estate Investing 101. There should be a link right here that pops up for you. And if that didn't happen to appear, I put that link in the description for you below for your convenience. Alrighty, now let's compare landlord income to bank income. Being a landlord is pretty self-explanatory. You buy a property like this one, valued at say $100,000. A tenant moves in and pays you for the right to live in the property. With the money they pay you in rent each month, you then pay the property taxes, the insurance, any maintenance and repairs, and whatever debt that may be on the property. And then don't forget the property manager. And whatever is left over is yours to keep. That's what we call your cash flow. Let's say this property cash flows $200 a month after all of the responsibilities are taken care of. This is a good result. Now, if you were to sell the property using seller financing, you're no longer the landlord. You are now the bank. Because you're the boss of your own bank, you make the rules as to who you lend to, and because you do, a buyer is typically willing to pay a premium for the property in exchange for flexibility with your lending guidelines. So instead of selling it for $100,000, you get to sell it for $110,000. You ask for a 15% down payment of $16,500. You then finance for the buyer the balance, $93,500. You slap on an interest rate of 6% on the financing and receive a monthly payment from the buyer of say $560 a month. That's more than double your cash flow than if you had just held on to the property. Not to mention the cool $16,500 you collected for the down payment. So if you can see with this scenario how you wouldn't need too many deals like this to set yourself financially free, let me know by smashing the like button. Indeed, this is a good result too. It might even appear to be a better result for you. But as with most anything having to do with real estate, it depends. This good result can be a great one. And here's what I mean. As the landlord, you own the property. You're responsible for everything having to do with the property. And in exchange for that responsibility, you also get the benefits of the property, all of the benefits. You receive a moderate monthly cash flow, as I showed you, but you also get the leveraged appreciation, the depreciation, the amortization, and you're hedged against inflation. Collectively, being the landlord is how wealth in real estate is created. Now, as the bank, you relinquish ownership and the responsibilities, which may be a good thing for you because that includes no more headaches that can come with tenants and toilets and termites. You get a good chunk of cash at closing via the down payment, plus a bigger monthly cash flow. Basically, less stress, more money. But there's a trade-off, and it's significant. You lose the leverage, you lose the appreciation, the depreciation, and the amortization. And you don't just lose the amortization, it actually works against you. As every month that the buyer pays their mortgage to you, the amount of money they owe you gets smaller. your asset is getting smaller each month. Not to mention that the cash flow you receive from the buyer's payments is taxed at a higher rate than the landlord income. And that's significant as well. Further, you're vulnerable to inflation. Most think of inflation as eating up the value of your dollar, but it also eats up the value of your debt. So if you're borrowing, that's a good thing. If you're lending, that's a bad thing. And inflation is a bigger concern today than it has been in recent memory. Collectively, being the bank is how wealth shrinks. So now, is being the bank by selling with seller financing a bad long-term play? Like I said, it depends. And here's what I mean. There was a point not too long ago where I owned 300 plus doors, and they were becoming a serious pain in my ass to manage. So I conducted an 80-20 analysis on my entire portfolio to see which of my 300 doors were performing the best so that I could get rid of some of the painful ones, if not all of them. I ended up selling a bunch. I took the proceeds from the sales and paid down some debt on the properties that were left to where I ended up keeping around 100 doors or so. But I created a bit of a new problem for myself, or I should say an opportunity. One of the great reasons to own real estate is for the depreciation and deductions. Because the way that the tax code works, you can actually show a profit from your real estate in your bank account, but show a loss on paper in your tax returns. When you can show a loss, it offsets and oftentimes even erases the taxes you would normally have to pay on the money that you make. Unfortunately, you can't write off more than you make. So whatever losses are left over, you get to carry them forward into the future to offset future earnings. My issue was with 100 income properties, I likely will always have more to write off than what I make, resulting in more and more losses to carry forward. Well, that's lost money, unless I go make some more to counter the losses. Ideally, I want my gains to match my losses so that they cancel each other out and I pay zero taxes, legally, honestly, morally, and ethically. You could call this the Trump plan. You know, he caught a lot of heat for only paying $750 in taxes. Well, if you know his history as a businessman, mixed in with his wins, he's had some big losses. And he's probably carrying them forward still to this day, wiping out the tax liability on the money he does make. You may not like it, but it's perfectly legal, and the law applies to you equally. That's all I'm doing here, is taking the same tax code, albeit on a smaller scale, and using it how the IRS said I could use it. They gave Trump permission, they gave me permission, and they've given you permission as well. Now, I would like to make more money, but I don't really want to do any more work to get it. So my CPA suggested a way to get the best of both worlds. More money, less work. So my CPA suggested to sell some of my 100 properties with seller financing to be the bank, thereby eliminating a bunch of landlord stress while increasing my monthly cash flow. But just to a point where it aligns with my losses so that they cancel each other out. Now my bank income, of which is taxed at a higher rate, isn't taxed at all due to the tax benefits that I get from the landlord income. Every year, my CPA looks at the portfolio and lets me know what I need to do more of in the coming year, to buy more with financing or sell more with financing. Because I balance these two strategies in my portfolio, I get maximum gains with minimum effort. That's the great result I referred to in the beginning. At the end of the day, do what you feel is best for you. Just wanted to give you a different perspective on the ultimate cash flow exit strategy to consider before making your important decisions. What did you notice? What did you learn? What did you find most useful? Share with me in the comments below. And who do you know that may also find this useful? When their name comes to mind, please share it with them. I pulled this video right here, special for you to watch next. Otherwise, I'll see you next time. Thanks for watching.